Welcome to the Wall Street Crossover Show, brought to you by Tip TV in conjunction with the sponsors for this segment, Admiral Markets. It gives me great pleasure to introduce Mr. Darren Sinden, market commentator for Admiral Markets. Morning to you, Darren.
Afternoon, miss.
A good week for the indices this week.
Yes, well, better than we've seen for a while. Given the backdrop of what we're waiting for, really, the ECB and Bank of Japan to do something on the downside as far as rates are concerned, and the Fed likely to move, or keeps talking about moving anyway, in December. It's perhaps surprising that equities have done so well. Maybe we've come to a little bit of a hiatus for the moment, and obviously looking out to next week, we've got a quiet week with the Americans on holiday at the back end of the week. So we'll see. But yes, all in all, not a bad performance, especially given last weekend's events as well. So
understood. Okay, we've got a number of slides to go through. Let's kick off with the first slide. Data released over the European session. What's caught your attention this morning?
There's not been a great deal, particularly data-wise, this morning, but we heard from Mario Draghi, boss of the European Central Bank, who was speaking at a banking conference in Frankfurt. He did go on for quite a while, actually. In fact,
did he?
I stopped listening after about 10 minutes.
Right.
But the upshot of the whole thing was that he effectively said that the ECB will be prepared to do whatever it takes to get inflation going again. We'll look at the end of the presentation as to how they're set to do that. The euro eased on as he was speaking. The expectation being of further QE, more euro printing, etc. And then we saw a data point that probably doesn't get as much publicity as it should from China. The Conference Board leading economic index dipped to a reading of 0.6% from the prior read of plus 1.6%. This is one of those composite indices of 6 Chinese leading economic indicators, i.e. things that predict where the economy is going. So it's a data point that perhaps, as I say, people should pay more attention to. Not surprising, I suppose, that it should fall, but it's a bit of an erratic indicator. But that's where we left with. And in terms of
week ahead,
data for next week, we've got flash PMI data for France, Germany, and the Eurozone as a whole on Monday. That's data for November. Then on Tuesday, quite an important number here, German GDP for Q3, and also the influential IFO survey for Germany. That's Tuesday. Then Wednesday, French consumer confidence for November, and Italian industrial orders for September. Here in the UK on Wednesday, we've got our own autumn statement, or mini budget if you prefer. And then on Thursday, we have Eurozone private loans for October. So that's an indication really of how much of the QE money is getting through into the real economy across the Eurozone.
Understood. Let's take a look now at the movers and shakers in Europe.
Well, for a change today, I thought we'd just have a quick look, and as we're approaching the end of the year, and see how European equity indices have been doing generally year to date. And as you alluded to at the beginning of the programme, it's actually a better picture than you might have imagined. Right at the top of the chart, the KFX, the Danish index, up an astounding 33% year to date. And given the problems that the Danish economy has, that really is impressive. Ireland as well. The ISEQ index 27.7%, and the DAX mid-cap up 25.6%. So some of these peripheral European indices and the German mid-caps are doing particularly well. To the downside, though, Spain, which obviously has been one of the better performing economies around Europe over the course of 2015, just a plus 0.7% gain in the IBEX year to date. The SMI in Switzerland, just 0.3%. Feel a bit sorry for the Swiss, really, because they're struggling with their currency valuations. But their companies are putting in a good game, and yet the index can't make much of a headroom. Overall, European volatility index is down 10.5%, and no surprise perhaps to see the biggest laggard being Greece. Down 18.8%. The FTSE, just for reference, as of these prices all of as of the close last night, down 3.6% year to date.
But there would be dividends added back in with the yield 3.5% just to...
probably. So you've got to be a little bit careful. But broadly, the FTSE's gone nowhere over the course of 2015.
Yeah, there's quite a big outperformance there in certain sectors, isn't it?
It is, yeah.
OK, let's move on to M&A, rumours and shakers.
Okay.
Pfizer.
Yeah, well, back in the spotlight again in probably the biggest deal of the year, possibly
corporate history is.
Yes, I think it probably is, yeah. So Pfizer, that's PFE in the US, is in talks with rivals Allergan, AGN, the ticker there, about a possible tie-up. It's quite an interesting deal, this, because it would take the form probably of an Allergan takeover of Pfizer, or at least that's how it would look on paper. But effectively, Pfizer would be buying Dublin-based Allergan in a so-called sort of tax-efficient structure, which is really aimed at avoiding a recent crackdown in the USA on these inversion deals. Now, Pfizer tried to do just such an inversion deal back in 2014 when it bid for UK's AstraZeneca, and it was prepared to pay, I should say, around £69 billion for AstraZeneca then. But US giant was forced to walk away in May 2014, well, it didn't seem that long ago.
Seems like yesterday.
It does, doesn't it? When AstraZeneca just basically rejected all their advances. So as we said, this would be amongst the bloodiest mergers in US corporate history if it went ahead. The market cap of the combined group would be something around $328 billion, a staggering sum. In terms of how the deal would play out, suggested terms would value Allergan stock at around $355 a share against the closing price last night of around 301.73. I suspect the discount is because of all the controversy around the deal. They're likely to move to close the deal very quickly if they can. Perhaps I've read within as little as a fortnight. But I think the truth is that a deal of this size, and also one that's got overtures of tax avoidance around it, is going to attract a lot of scrutiny from Capitol Hill and the US Department of the Treasury. So I'm sure you'll be hearing US politicians speaking out about the ethics of this deal going forward.
Understood. In terms of US data points to keep an eye on, what have we got today?
Slim today. So we've just got the Kansas City Fed Manufacturing Index out later. We can't seem to get away from Fed governors speaking. It's actually becoming quite boring now. Usually,
almost like a soap opera.
It is. I mean, a day doesn't go by.
As regular as a soap opera, anyway.
A day doesn't go by without one of them coming to the microphone. It seems now, and they keep talking the same story as well. So. It's a diminishing return on that. Next week, we've got PMI data for November on Monday, flash PMI that is. Existing home sales coming out also on Monday. And then GDP on Tuesday. And because it's Thanksgiving on Thursday, weekly jobless claims get bumped back to Wednesday. So
we'll move a day forward.
Yeah, well, exactly, yeah. So we've got a reasonable stab at data points, but obviously as we get sort of Wednesday afternoon, most people in the States will be heading off and not coming back until the following week.
Understood. Let's take a look at some US pre-market movers and some chart points.
Okay, well, the first stock that's taken my eye in the US this afternoon is Intuit. That's INTU even in the US. These are a rival to the UK company Sage, trading around $105.36 pre-market, up around 8.15%. Quite simply, Intuit reported after the close last night. They beat on EPS and revenues and guided higher for the coming quarter. And in fact, they hiked the full year for 2016 EPS guidance by as much as 5 cents to $3.45 stroke $3.50. So, very positive read across there. That interestingly, though, it hasn't been reflected in the Sage share price today. I don't know if people have missed it or whether they're starting to diverge. And then a company that I hadn't really heard too much about before today, Mentor Graphics Corp, MENT, in the US. This is a company that specialises in design software. They missed Q3 estimates and guided below consensus after the close last night. This is for Q4 revenues and EPS. Market was very disappointed what they heard there. $20.40 there trading, down $26.50. This is one of the things you always find in America, companies you've never heard of. You look at the market cap, this is a $3.25 billion company.
Really?
So it's a significant business, but one that's sort of been hidden under a bush up until today. In terms of cash levels in the indices, as you say, things are a little bit better, but trade is quite quiet. FTSE back into a reasonably narrow range. It's around 6,300 on the downside, plays 6,360 to the upside. In the DAX, we go with 11,050, plays 11,130 to the upside. And for the US markets, the S&P 2070 at 2088 now, the range there. And the Dow 17,695, plays 17,850.
Currencies?
Well, as we said, there was a bit of weakness, a further weakness for the euro, Draghi speaking. So 106.56 now is our downside level, plays at 107.05 to the upside. For the Aussie dollar, 71.70 on the downside, plays 72.40 to the upside. If you look at the monthly chart on this one, you can see some very clear resistance just above the current price, and a scope perhaps there for a third sell-off in a row from these current levels. Dollar yen, 122.60 plays 123.10. Probably the biggest surprise of the whole month of November has been the stability.
I was going to say the lack of movement.
Yeah, very surprising indeed. And for cable, a bit of round number action today. 152.50 we've nominated as our downside level, plays 153 even on the upside. I suspect that the path of least resistance is to test but up to 153.00, but we shall see.
Okay, let's wrap up with our last slide. In focus, what are we watching? How long can Eurozone yields go?
How low can Eurozone?
Low or long, sorry, low.
Yeah, well, okay, I mean, so Draghi spoke this morning and basically pointed out, I think he ran through a list of up to 30 problematic areas for the Eurozone. But as I say, he said that he would, or they would take the action that's necessary to revitalise the economy and particularly to get inflation moving again. So market expectations are for further ECB stimulus to be announced by year end. As we said, Mario Draghi said he would do whatever it was required to get inflation moving. But the question must be, as more Eurozone bond yields move into negative territory, how effective can QE be in this? And this is just a table drawn from the ECB's own data. Eurozone maturities here and the yields to maturity on the right hand side. So 3 month, very short term debt trading around minus 0.35, wow, all the way out to 3 year debt trading at minus 0.9%. So and it's creeping further along the curve. The red line, dotted line there, indicates where we sort of break even with yields sort of at zero or positive. Germany recently sold short-term bonds at negative yields, and that, minus 0.3%, and some 40% of its issuance now trades below EU deposit rates, or ECB deposit rates, I should say, and they're already negative. So this sort of negative sort of group of bonds, if you will, is getting bigger and bigger. That does two things. It means that if the ECB does choose to buy them, they're basically going to lose money. Security. Secondly, there's a very much a diminishing return from buying bonds that are already sort of priced out and very well held. You also you have to question whether people want to sell them anyway. If they're prepared to put new money into German paper at negative yields, why would they then want to sell them to the ECB? They're suggesting that people are buying them as a store of value, regardless of the fact they're potentially taking a capital loss. So I think Mr. Draghi's job is being made increasingly hard by the markets, and he's going to have to perhaps be a bit more creative in what he does to try and turn the Eurozone around.
Understood. Darren Sinden, market commentator for Admiral Markets, thank you very much for your time. We'll see you same time, 1 p.m. on Monday. Have a good weekend, people. Thank you.